everyone, happy Thursday as we are slowly heading toward the end of the week. Welcome to Within the Frame, where we delve deeper into the top stories not only in South Korea but across the globe. I'm Kim Bo-kyung. Today, the Federal Reserve raised its benchmark rate by 25 basis points as largely expected. Now, though baby step, the Fed has again widened the interest rate gap with South Korea. Meanwhile, the International Monetary Fund has forecasted growth in the global economy, and compared to an upward revision overall, the IMF lowered its growth estimate for South Korea. Though reasons have not been officially cited, some experts attribute this to the increasing burden of household debt and weakened consumer expenditure due to previous rate hikes. With all of this considered, what decision is Bank of Korea going to make at the upcoming rate-setting board meeting? For an in-depth analysis on the reasons behind Fed's baby step, the IMF's outlook, and the BOK's decision soon to be made, we invited Yang Jun-sok, professor of economics at Catholic University of Korea. Professor Yang, welcome to the show.
Happy to be here.
All right, and we also have Lee Moon-sup, assistant professor of economics from the UC San Diego School of Global Policy and Strategy. Professor Lee, welcome, and thank you so much for your time.
Thanks.
All right, let's first dig into the Federal Reserve's decision to slow its target interest rate increases. Now, Professor Lee, the U.S. Fed, at its first meeting of the year, announced a so-called baby step, raising its interest rate by 25 basis points. Quite a modest hike compared to earlier steps taken in 2022. But why the baby step this time?
So 25 basis points was the smallest increase in almost 1 year. So this came from two factors. First, inflation is moderating. Second, the Fed is cautious about negative consequences the rate hikes are making.
Right. Now, Professor Yang, a number of global experts expect the Fed to take another baby step in March and perhaps even a potential rate cut within this year. But Fed Chairman Jerome Powell, he said on the other hand that the job is not fully done and that he doesn't expect any rate cut within this year. Now, how do you see the situation in the United States right now? And what is your takeaway on decisions the Fed is going to make in the future?
Okay, well, Chairman Powell really did try to very much try to get rid of the idea that the Fed is likely to lower the rates at the end of the year. He did leave the possibility open if the data calls for it, but he re-emphasized again and again that he does not expect the rate to fall this year. And the reason is if we look at the inflation numbers, taking the latest consumer price index inflation, which is for December, for 12-month inflation, it was 6.5%, so it's still very high. But just for the month of December, it was minus 0.1, so inflation seemed to have actually gone into perhaps a deflation. But if you look at the core inflation, 12-month core inflation was 5.7%, and what's notable is 1 month for December, core inflation was 0.3%. So core inflation was much higher than headline inflation. Until now, the main cause of inflation was thought to be energy and food stuff, but core inflation strips out the energy and food. So that means the cause of inflation has shifted. We thought previously the main cause of inflation was, as I said, foodstuff and energy because of the pandemic, supply chain problems, and Russian invasion into the Ukraine. But right now, the foodstuff prices and energy prices have stabilized.
Right.
But so what accounts for high core inflation? Services. If you look at services inflation, it was 7.0% over 12 months and high 0.5% over the month of December. And a lot of that is due to shelter services, 7.5% over 12 months, and 0.8% in December alone. Now, there is some controversy over how you calculate the shelter inflation, and some doves are claiming that the impact from shelter is not as big as these numbers indicate, but still, the services are now the main driver of inflation, and that's probably going to be harder to control than previous inflation due to foodstuff and energy, because most of the causes for services inflation is wages. And U.S. labor market is right now very, very hot. The wage increase is about 4.6%. The unemployment rate is 3.5%. And before pandemic, we thought that full employment rate for the United States was somewhere between 4.5 and 5%. And it's a full percentage point or more below that figure. So the labor market is very, very hot. Wages perhaps are not increasing as much as inflation, but still very high compared to the Fed's goal of 2% inflation. The Fed considers inflation still too high, and they will have to continue to raise the rates for the future. And every member of the FOMC has agreed that they will continue to raise the rates for the first half of the year, and they will probably raise it to the top rate of 5.25%. So even with the increase we had today, that means they're on schedule to have at least 2 more baby steps during the first half of the year. Now, the FOMC members seem to disagree on what would happen during the second half of the year, but no FOMC member has said that they will lower rates. Some have said that maybe it's better to freeze it. Some have said that we need to continue to raise the rates, but no one has said that they will lower the rates. So what I expect is that at least for until June, the rates will continue to rise, and then we'll have to look at the data to see whether further increases in interest rate is warranted.
Right, so it's not going to go down as we are expecting it to be. But Professor Yang, I would also like to explore how the Fed's decision is going to affect South Korea's interest rate. Now, with Wednesday's announcement, the interest rate gap between South Korea and the United States has widened to as much as 1.25 percentage points. This is the widest since October 2000, so they say. And many people will say that BOK is not going to be able to ignore such widening gap in rates between the two countries, but I wonder, could you elaborate to our viewers why this really matters and how it will influence the BOK's decision?
Okay, well, Korea is typically thought to be a more dangerous place to invest than the United States. United States is the safest investment in the world. Now, the U.S. interest rate right now is higher than Korean rates, so not only are they safer, but there's more income that you can get from investing in the United States. So we usually expect investment to flow from Korea to the United States. That has happened last year, though slowly. And then whenever the gap increases, when the U.S. rate is higher, there is a higher possibility of rapid changes in the exchange rates. We saw that during the autumn of last year. And if that blows up, then the worst possibility is currency crisis and financial crisis, as we saw in 1997. Now, that is a very small possibility right now. Most people do not believe Korea will get into a currency crisis, but we certainly can get into a period where we have a very rapid depreciation of the Korean currency like last autumn. And the chances of that increases as the interest rate gap increases. So if the foreign currency market, foreign exchange market is unstable, then Korea should increase the interest rates to keep pace with the United States. But right now, luckily, the exchange rates are stabilized. In fact, it's getting better. Korean won is appreciating right now. So we don't have to worry on that account. But Korea still is suffering from a relatively high inflation rate, not as high as the United States, but above Korea's norm. So we will probably need to raise rates overall, but because the U.S. raised the rates by only 25 basis points, we may be able to get away with not raising the rates on February.
Right. Now, Professor Lee, meanwhile, due to the continuous rate hikes and uncertainty brought by the Ukrainian war, the growth forecast has been on a downward trend for a long time, but the IMF hinted at a turning point for this year, saying the world economic outlook is going to expand 2.9% this year. Now, what's behind the change in outlook? And could you tell us more on the growth expected for major economies around the world?
So let me clarify one thing. So expected growth of the 2.9 is still lower than actual growth of 3.4 this year. So the economy is slowing down. Going back to the optimistic revision, there were two reasons. The first, the inflation is slowing down. So we expect only the modest increase in interest rate globally. And second, the China is reopening much faster than what IMF and we expected. So that's why the IMF changed their forecast.
Right, Professor Lee, I'd like to ask you one more. Now, I'd like to focus on the outlook for South Korea as well. The IMF projects South Korea's economy to grow 1.7% this year, but that is down 0.3 percentage points from the agency's previous forecast. Now, the update comes in contrast to the IMF's outlook for the overall global economy, even lower than Japan's, actually, for the first time in 25 years. Why is this the case?
So the forecast for Japan is the 1.8%. So 0.1 percentage point difference between Korea and Japan is within the forecast error bound. So we don't need to worry too much about it. But going back to the reason why the IMF revised the Korea's forecast down. So yeah, IMF didn't say why, but it may be due to the weak consumption prospect. The Korean households are much more cautious and less confident, mainly due to the high debt and then the burdens coming from the increase in interest rate payments they are making.
Right, weak consumption prospect. Now, Professor Yang, then how should the South Korean government manage the risks that are having a negative effect on the country's growth projection?
Okay, well, the government is stuck in a very difficult place, and so is Bank of Korea, actually. If we want to raise growth, we need to lower interest rates, but then that will worsen inflation.
Right.
And since the Bank of Korea's main job is to control inflation, they're not in a place to lower interest rate for the near future. So any adverse effects from keeping interest rate high and even raising it further, government will have to do something about it. But if government spends too much money on fiscal policy, that will worsen inflation, that will make the period of inflation longer, and that may even induce Bank of Korea to raise interest rates even more. So I think the Bank of Korea has to have a very selective fiscal policy for people who are most affected. The poorest part of the population, the most vulnerable. I think there definitely should be more aid going there. But type of universal assistance that we talked about last year, I think that should be ruled out because that will work against inflation and that may make the period of high interest rate for Korea even longer. And then having said that, we should, I think, try to take care of household debt and corporate debt. Professor Lee mentioned that the high corporate debt is making consumption difficult. Same thing, I think, applies for corporations, businesses as well. Korea, while not ranked number one like household debt, we're ranked, I think, something like 4th or 5th in terms of corporate debt as well, and that's also going to slow down investment. So you can rule out consumption, you can rule out investment, and you probably can rule out exports at least for the first half of the year as well, because global trade is expected to go down. So the only thing that's left is government expenditure. And we will have to use government expenditure very carefully if we don't want to extend inflation.
Right, so the government has to make selective, support for the people, and also we need to control the corporation debt. Now, Professor Lee, the Bank of Korea's next rate-setting meeting is soon to come, which is late February, but pressure over soaring inflation remains as heating bills soar and increases are possible for other utility rates such as electricity as well as transportation fees and so on. How is this going to affect inflation in the country?
Yes, so Korean households are suffering from soaring the heating bills. The part of that is seasonal, coming from cold winter. But you mentioned the electricity, so we should watch closely how the global oil price evolves. And the one major factor is how much the China's reopening, the increasing demand for the oil would increase the oil price. So we should watch closely the evolution of the oil prices and then make a monetary policy decision according the appropriately based on that.
Right. Professor Lee, the government announced a set of measures to help the country's vulnerable people to cope with a spike in heating and energy bills. But I wonder if this is going to really help. And what other measures do you believe authorities need to come up with to tackle inflation-related issues? I mean, Professor Yang told us that the government support should be selectively made. What is your takeaway on this?
I'm agreeing with Professor Yang's point. So I think he may have even more the detailed opinion about the instrument the fiscal authority of the Korea can use. But I'm 100% with Professor Yang about providing that support to the people who need the support.
Right. Now, Professor Yang, then we need to tap on the meeting's result in February. Now, considering faltering private spending in South Korea due to speedy rate hikes and also the soaring utility bills, what decision is going to BOK make? Okay,
well, this depends on the condition that the foreign exchange market will remain stable. So dollar won exchange rate will remain stable. Then I think there's a very good chance that the Bank of Korea will freeze the rates on March. I think because Korea economy is weaker, and because the Fed is now expected to only raise the rates by baby steps in March and May, I think Korea does not need to keep up with U.S. all the time. So we sort of earned 1 month where we don't have to raise it. And the question is whether we will use it in February or whether we will use it in April. I think there's a better chance that they will use it in February because, well, right now, because of the last quarter, we had a negative growth. I think there's more impact we can have if we don't raise the interest rate now. And also, I think politically, the politicians would prefer to kick the bucket and raise it later. And because the Bank of Korea doesn't necessarily have to listen to politicians or take them into account, but I think they will realistically. And then because the dollar rates are stable, if they wait, say, until April to raise the rates, something might happen in the dollar market. So I think because they've earned this free, let's not raise the interest rate card, they will use it in February because, at least for them, it's safer. Right, so the BOK might make a decision to freeze the rate in February. Right. Now, unfortunately, this is all the time we have for today's edition, but thank you, Professor Yang, and Professor Lee, thank you so much for your insights and for your time. We really appreciate them. Thank you. All right, that's all for Within the Frame tonight. Have a great Thursday. We will be back tomorrow with more in-depth stories on the issues happening in South Korea and, of course, around the globe. Thank you for watching, and goodbye.